In this one video alone, you're going to learn everything you need to know about the three most popular and safest investment ventures in Uganda: unit trust, treasury bonds, treasury bills. Bonus, you're going to find everything about the NSSF Smart Life Flex account, and you'll first learn the factors you need to consider before choosing where to invest. Make sure you watch until the end of this video. I've just put together all the videos that I've ever made that make it so simple for everyone to understand these ventures, even if you do not have a formal education, for as long as you have the basic understanding of English. These are the 12 factors to consider when choosing where to invest your money in Uganda. Is it in unit trusts? Is it in treasury bonds? Is it in stocks? Should you put money in the Smart Life account of NSSF? Where should you invest your money? I have been asked a number of times by you on whether you should put money in unit trust and which one gives you the highest interest. And today I just want to make sure that you consider the right factors, because most of us make a mistake and put money in a particular venture depending on only one factor: profitability. So in this video, we are going to look at 4 things. Number 1, what is an investment? Number 2, what is an asset? Number 3, what should I consider on choosing in which asset to invest my money? Number 4, I'm going to give you a free bonus, a comprehensive step-by-step guide on investments in Uganda. So before we start, remember to save this video for future reference, repost for friends, and if you have anything you've not understood, please put it in the comments, or something you want us to expound on more. Question number 1, what is an investment? I'm going to explain it in the simplest layman's language that I wish someone used when I was younger. An investment is a process by which we allocate resources in an asset with the intentions of increasing its value. Let me simplify it a little more. An investment is when you get a resource, in this case money, put it in an asset, for example land or a bond, with intentions that after some time it will increase in value. But what is an asset? Is anything you can use to exchange for value. It could be land that when you exchange it, you can get value. Now, before we look at the factors someone should consider to invest, let us look at my 3 classifications of investments. Number 1 is capital preservation investments. Now, this is where you put money in an asset, and by its nature, it increases in value over time. So it may look like your main purpose was to preserve money, but actually in the process, the asset increases in value. The asset could be land. If you know any other example, please put it in the comments. The second form of investment is called capital accumulation investments. Now, this is when you put resources or money in an asset so that money can make money. They are money markets, or they are money assets. You've put money in treasury bonds, so money is making money. Money is in unit trust, money is making money. Money is in a fixed deposit account, money is making money. That is capital accumulation. Then lastly, we have wealth creation investments. We call this business. This is where you put money in a venture that is active. It has many resources that come together beyond just money to make money. When you open up a restaurant, when you open up a boutique, when you open up a company, that is a wealth creation venture. So what other factors should one consider before they decide where to invest their money? Factor number 1, capacity. How much money do you have, or can you afford to put aside in investments? If you are about to save 5,000, then it means you only have one choice in Uganda: the Smart Life account of NSSF. If you increase it to 10,000, then you have the Smarter Life. You also have unit trust with Zeno specifically. If you increase your amount to about 20,000, then you have Standard Chartered unit trust, what they call the shilling fund. And if you increase to 100,000, Now you play the big game. You can invest in treasury bonds, you can invest in bills, and all these other options down. Of course, 100,000 cannot allow you to go into land, but it can actually buy stocks because some stocks are actually way cheaper than unit trusts. Relatedly, number 2, frequency. After deciding how much you can put aside, I need you to think of how often do you want to be investing. Is it daily? Is it weekly? Is it monthly? Is it yearly? Is it a one-off? Those who have been following me, you know we have a daily investment challenge. And when I told people to invest on a daily, I didn't mean that every time transact, every time deposit. But if you can, wonderful. If you cannot transact on a daily, set your target and say, on a daily, I should be investing 5,000 or 10,000. If it's 10,000, it means by the end of the week, you have 70,000. You should be investing 70,000. So the frequency of how often you're going to invest is also important. Because, take for instance, you cannot invest every day in treasury bonds, especially if you're going to play the primary market. Now, after you've considered your capacity, your frequency, the next most important thing is your purpose. Why are you investing? There's someone who is investing for retirement. There's someone who is investing to buy a car or to buy land. But also, there's someone who just wants cash flow. And another one just needs a side gig or a side source of income. So all those factors play in favor of different investment ventures. For example, if you're going to invest because you need a guaranteed cash flow, then a treasury bond is more guaranteed. Vis-a-vis, if you're going to put money in stocks that are likely to declare their dividends at the end of the year. So the stocks might actually make you more money, but they will not allow you to have a monthly cash flow. At the same time, different from the person investing for child's education. In that case, you'd invest in an insurance policy because that guarantees that your child goes to school whether you are alive or not. Now, if you want details about insurance, I have a friend of mine called Rebecca from Prudential. If you want her details, just inbox me or put it in the comments. But let's go to factor number 4, the term or the period in which you're going to invest. Are you going to invest for months, that you're going to put your money there for 3 months and you need it out? Then you go for treasury bills. Are you going to invest and you may need it for even after 1 week? You may need to go into unit trust. But are you going to invest for a long period of time? You may go for unit trust or treasury bonds. So it depends on how long you intend to invest this money. Number 5, liquidity. How easy is it to transform your asset into liquid cash? So if it comes to liquidity, things like unit trust are more viable. If you're a person who may need your cash anytime, then go for the unit trust, because with unit trust, you can access your money between 3 hours to like 72 hours, the worst. Factor number 6, knowledge. Never invest in things you don't understand. If how it works, you really can't comprehend, first be investing where you're investing. First, get information about this investment venture you're looking at. For instance, I'm organizing an investment seminar on 6th April. Now let's go to factor number 7, risk appetite. How are you willing to take risks? I have met a number of couples that are deciding where to invest money. I've realized that women usually have a low risk appetite. They don't want investment ventures that have high risks. Men, on the other hand, it's not that they don't fear risks, but they want high returns. And the higher the returns, the higher the risks. Women tend to choose stability and predictability. If you're a person whose risk appetite is high, then you can go for wealth creation investments or trading in stocks. But if you're a person whose risk appetite is low and low, your thing is treasury bonds. If you take a little bit higher risk, you go to unit trusts and like that and like that. Factor number 8, relating to risk, is security and safety. Now this comes to regulations. Most of the investments around Uganda, especially unit trust, treasury bonds,
bills, stocks are regulated, and they have. But beyond regulations, the nature of the assets or the nature of the vehicle you're going to invest in comes with particular levels of safety and sometimes guarantees. For example, if you want safest in Uganda is a treasury bond. Why? Because with treasury bonds, your principal or your initial investment, the money you use to buy the bonds, is guaranteed. The other side of risk you should look at is volatility. How volatile is the investment you're going for? Stocks are more volatile than unit trusts. Unit trusts are more volatile than treasury bonds. Ordinarily, land would be like treasury bonds, but the problem with land in Uganda can be grabbed anytime. Factor number 9 is the asset manager's reputation. What is known about the person you want to invest with, or the company, the firm? The government of Uganda is known. Since 1969, that is 7 years after independence, it has been giving out bonds and it has never defaulted. The company you're going to invest with, can you read about it? Can you know their reputation? Can you know their effectiveness or efficiency when it comes to managing funds and other people's investments? Remember, if you see a company that changes CEOs and the board a number of times, like so frequent, there's something questionable there. If you're buying stocks, don't do it. There's a high likelihood that your money is safe with a company that is stable with its management team. Factor number 10 is profitability. Ask yourself, what is the interest rate? What is the interest rate compounding or simple interest? Compounding means it makes money on the interest it earns after a given period of time. For example, if we say it accumulates money compoundingly on a daily, it means every day there's an interest you earn. Let's say you've earned 3,000 on 10 million on a day. It means the next day, when they are giving you interest, they're going to give it on 10 million and 3,000. And then the third day, they will give it on 10 million and 6,000, like that. So yes, it is good to ask yourself, who gives me a higher interest? Whose stocks are more trending and are more profitable? Yes, consider all those factors, but it shouldn't be the sole factor that you consider. Now, I'm doing some research. Help me answer this question. If we developed for you a tool that can help you predict and consider different factors to estimate how much you're likely to earn in a given period, but it can also recommend, depending on your circumstances and needs, can advise you on where to invest your money, would you go up for that tool? And if it's an annual subscription, you pay it for a year, how much would you be willing to depart with for it? So factor number 11, accessibility and flexibility. Now, accessibility is about if you want to invest physically, are the offices of the fund manager or the company, the organization that manages that investment venture accessible to you? If you're deep in a village and you hardly come to a town, a city where banks are, it may be hard for you to invest in treasury bonds. Currently, it is near to impossible for you to transact from abroad in treasury bonds because you needed to come, fill up a form, and then bid. Now, flexibility is mostly about how much time do these people take to attend to you, to open up an account, to reflect your money. Can you sign up online? For example, the reason that's why most people are going for Zeno, NSSF, Standard Chartered, Stanbic is because you can apply and sign up online. Of course, even other unit trusts and other fund managers, after you come on board, the other transactions can be done online. But now, the last factor is transparency. Your fund manager, the firm, the company that is managing your investment, how transparent are they? Do they show you how you make money and how much you've made, and how often do they tell you that? Do they give you accountability? If people just come and declare you've made this, but you can't even know how you go to make that, there's a problem and it's fishy. So I would rather you don't invest there.
In this next section, you're going to look at everything you need to know about unit trusts. And if you need any special attention and help, just book our lunch hour group session. It is virtual. We help you step by step on how to start to invest. You ask personal questions, and usually there are experts in the meeting. Enjoy the section about unit trusts. Before we end this presentation, I want you to have learned what is a unit trust and how does it work. Number 2, who manages my investment? Number 3, how much can I start with? And lastly, how can I start? Before we begin, I have 3 requests. Number 1, that if you have anything you've not understood, put it in the comments. Number 2, that you get a paper and a pen and take some notes, or just save this video so that you can return to it later. And lastly, number 3, be patient. This is not the kind of content on TikTok where people are just dancing and enjoy. No, this is something for your own growth and learning. So let's start. How do unit trust funds work? Unit trust means we have someone who has put up a basket. We call it a pool fund, but has put up a basket collecting money that all of us are going to put in money to this person we are going to call a fund manager, And when he receives our money, he does invest this same money somewhere else. When he invests the money, he makes a profit or an interest. So he invests, let's say in your estate, in bonds, in bills, and so on, and he makes some interest. From the profit that he makes, he returns it and now starts giving it out to the different people that contributed to this basket. He gives back, he gives back, he gives back, he gives back. That's how you make an interest. And that's what a unit trust works. So question number 2. Who actually manages this fund? Who is this guy that we give our money? In Uganda, there are only 3 categories of people you can give your money, or people who help us manage our funds, make money for us. Number 1, we have banks. There are only 2 banks that I know in Uganda that do this. And we have A, Stanbic, and B, Standard Chartered Bank. The second category that we have that manages this fund are insurance companies. There are 4 insurance companies with which you can invest in unit trusts. A, Britam. B, Sanlam. C, ICEA. And lastly, my favorite, UAP. The last category of a fund manager that we have in Uganda are investment companies. Now, in Uganda, there's only one that deals in unit trust, and that is Zeno. This leads us to the next question. How much do I need to start investing in unit trusts? How much depends on the fund manager you're going to work with. If you're going to work with Standard Chartered, I know for sure that Standard Chartered begins with as little as 20,000, meaning you can invest on a daily, on a weekly, on a monthly, or as a lump sum, and you just say, I only have 20,000, and you put there to infinity. Stanbic, initial deposit, initial investment needs to be above 100,000, but recurring investments can be as little as 50,000. Most insurance companies, their minimum is 100,000. Zeno plays in 20,000. That means you, my friend, it doesn't matter how much you earn on a monthly or on a weekly, we can all actually invest in unit trusts. This takes us to the next question. Question number 3. What are the advantages of investing in unit trust rather than investing in any other ventures that are on the market? Simple. Number 1, a unit trust. This one we are not going to write, so please note down. Number 1, a unit trust, you can invest as little as 20,000. So anyone can invest, big investors or small investors. Number two, unit trusts are both good for short-term and long-term goals. Number three, most unit trusts give you an interest on a daily, weekly, and at worst, monthly. This doesn't mean that you have these big interest. If, let's say, for example, most unit trusts are between 10% to 12% per annum, you divide that by 365 days, but you receive your money on a daily for most of these insurance fund managers. Now, someone would ask, but that is little money. No, it is not. That takes us to the next benefit of investing in unit trust, which is compounding interest. Let's take, for example, if from 1 million shillings that you invested in for a year, you're supposed to get a 10% and you got 120,000, you divide it by 365 days. Really, I don't know how much you'd have gotten. So we assume you invested 1 million and at the end of the year, you're supposed to get 120,000. But because it's a daily interest, it means that you divide 120,000 by 365 days in the year. So let's assume you get like 300, let us just take 300 shillings for easy calculations. That means the day you invest your money, you're going to receive 1,300,000 shillings. So the next day when we are giving you an interest, we shall not give it at 1M, we shall give it at 1,300,000 shillings. That means it becomes cumulative. Every day there's an additional on your money. The last advantage of investing in a unit trust is at the same time its disadvantage is that it's accessible. For most of these fund managers, banks guarantee you between 12 hours and 24 hours. Most of these insurance companies will give you 12 to 72 hours, that not beyond 3 days can you have access to your money. Why do I say it is an advantage and at the same time a disadvantage? Is if you are investing to put away money for future goals and you have access to it, you end up utilizing your investment fund for things that could wait. I am just saying. Let us proceed to the next question, which is, how do I start? If you want to invest with a bank, Standard Chartered or Stanbic, all you have to do, go access your application. That is, if you already have an account with them, and look for an option where there's an investment. For those who are in Standard Chartered, I will take you through maybe in the next video, so make sure that you follow me. So literally, you can invest online as long as you have money on your account. If you do not have an account with these guys and you want to invest using banks, then I advise that first open up an account, have access to their online services, an application, and then invest online. You can deposit and withdraw money anytime you want using your application. For these guys, you look for an agent and the agent will sort you out. The last one is the investment company, which is Zeno. Just reach out to them, go to their website, give them a call, and they will guide you. It is very simple as that. So I hope me and you from today are going to start investing in these unit trusts on a daily, a weekly, or a monthly. None of you has an excuse. And mind you, except for your emergency fund, you should never have your money sleeping on your bank account, like in a savings account. Never. Except if it's an emergency fund. You must be done with the section about unit trust. Now we are going to look at treasury bonds. Everything you need to know and how to start investing in treasury bonds. And if you need any special attention and help, just book our lunch hour group session. It is virtual. We help you step by step on how to start to invest. You ask personal questions, and usually there are experts in the meeting. Enjoy this video about treasury bonds. Meanwhile, treasury bonds are the safest investment venture. And if you use the right strategy to invest in them, they could be quite profitable. Recently, I was speaking to a friend of mine, Uganda, this is on you, and he told me, that he has always heard people talk about treasury bonds, but he has never decided to invest in them. He has invested in a lot of things, but the way I explained them to him, he decided that he is going to start investing starting this month. And another friend of mine, Joe, told me that someone had lied to him that you can only invest in bonds if you have 100 million and above. What? You only need about 100,000 to start investing in treasury bonds. So today, my friends, I'm going to answer 5 questions about treasury bonds. Number 1, how do they work? Number 2, why should I invest in treasury bonds? Number 3, how much do I need and how much do I earn? Number 4, how do I start? And lastly, what is my winning strategy? As we begin, I also have 3 requests for you who is watching. A, please get a pen and a notebook and take some notes. But if you don't have one or you can't note down, save this video for future reference. And lastly, I beg of you, be patient. This is not your type of content that you see on TikTok, dancing and no, this is content to develop you, to grow you, where we share lessons with each other. So let's begin. How do treasury bonds work? I need you to know that I'm going to use the simplest language for anyone to understand this concept. A treasury bond means that the government of Uganda needs some money and wants to borrow from its citizens. So it tells Bank of Uganda, which we also call the central bank, to get money from the citizens, which will be used to develop roads, hospitals, or the other reason could be that we want to reduce foreign aid. We want to reduce foreign debt. We don't want to borrow money from other countries. So let's borrow from our own citizens and they earn something from them. So what the Bank of Uganda does, since they're not everywhere in your village, in your district, in your sub-county, they also instruct banks, commercial banks, to do what? To come and borrow money from you. So through your bank, Stanbic, Standard Chartered, Housing Finance, and so on, you lend money to the government of Uganda. And at a given agreed period of time, your money is returned to you, a pulley here, with an interest. So these are the other facts that you need to know about how treasury bonds work. Facts. Fact number 1 is that any individual, company, or circle can actually invest in treasury bonds. Number 2 is that the amount of money you need is only 100,000 to start with. So we have 100,000 to 200 million. This group we call price takers. Now, follow me closely. Later, I'm going to tell you what is the difference between these guys. And there's another category of people who can invest 200 million and above. And these ones, we call them price setters. The reason as why I've introduced this, the reason as why I've told you about this too, is because there are rules that apply to this guy that do not apply to this guy and this guy. And number 3, I want you to know that there's what we call a primary market and a secondary market of treasury bonds. So what is primary market? Primary market means that Bank of Uganda actually sells what the technical guys call auctions out treasury bonds. But it simply means that government invites people to come and lend money to it. And usually they do it every after 28 days. And you can find a calendar on when they invite people to invest in bonds on the Bank of Uganda site. But you can also follow me. I'll keep on giving you details. Number 4, secondary market. Secondary market means that if you invested in a bond for about 10 years, but after 2 years of running this investment, you feel like you want to pull out. So there's 8 years remaining. Now, what they are going to do is they are going to put it on what we call the secondary market. We are going to trade it out with other people. If there's some other guy who can buy it at 8 years and only take the privileges of 8 years, well and good. We move on. The question is, what is our last fact, which is about how long do I need to invest? You can invest 2 years, 3 years, 5 years, 10, 15, and 20. Remember, these are different from treasury bills. If you want to know about treasury bills, follow me. Tomorrow we are going to have a video on what treasury bills are. Treasury bills are short-term, treasury bonds are long-term. So let's handle the next question. Why invest in treasury bonds? 6 reasons why you should invest in treasury bonds. Number 1, cash flow. Cash flow means that if invested rightly, you can have an interest, you can have money the other month. Money keeps on coming in. Remember, a treasury bond has what we call biannual interest. Being biannual means that after 6 months, after a half of the year, we pay you an interest. If your interest was supposed to be 1 million at the end of the year, we just divide it by 2, and after 6 months, we give you some 500,000. I hope that is clear so far. So number 2, collateral. So if you have this guy, you've all received 100 million, and the guy wants to invest in trees, buy land of 50 million, then grow trees. This is how you beat him. You can buy bonds worth 100 million, and after buying bonds of 100 million, borrow money from the bank, still 100 million, and do forests and even buy land. So you have an investment here and you have an investment here. You just start paying off the loan. Number 3, ease of transaction. It is easy for you to start investing in treasury bonds, and I'm going to take you through before the end of this video. Number 4 is liquidation. Liquidation means that this money is available in liquid. It's like money. Anytime you need it, you can access it. How? You remember we talked about the secondary market, that the moment you feel like, okay, I really, really need this money, we can put it on the market and someone will buy it and you get your money. So number 5 is diversification. This simply means that in any investment and in business and in life, we are advised that never put all your stones in one basket. So if you've invested in somewhere in business, you've invested in circles, you've invested in investment clubs, you've put money in the farm, you've put money in some shop, also put money here. And you see, the bond can also operate as an insurance, that you see other things may not work, but this is assured, which takes me to reason number 6, safety. The government of Uganda has been borrowing money through bonds from its citizens since 1969. That literally means that 7 years after independence, and it has never defaulted. Why? Any change of regime, the next government that comes, it takes over the liabilities of the previous government. So safest. So our next question is the one most people are interested in. How much do I need to start? And how much do I earn? Now, number 1, we've already talked about this. Here, we have 2 categories. Category number 1 are the people I told you about that we call the price takers. And these guys can invest from 100K to 200 million. The reason as why I'm specific about them, that the moment your investment money is below 200 million, your bid, your decision to invest in a bond is automatically accepted by Bank of Uganda. But there are these guys who are above 200 million, the ones we call price setters. These guys negotiate on your behalf. They literally determine the interest rate. We are not going to go into that. All you need to know that you, who is likely to be below 200 million, the moment you buy a bond below 200 million, you automatically be accepted. So how much do I earn? So even at earning, I want you to take note of 2 facts. Number 1 is that your interest is going to be between 10 to 15% per annum. Per annum means every year. Simply suggesting that the guy who has invested about 20 years in a bond is likely to have a higher interest. Now, fact number 2 that I want you to take note of is that there is some taxes. Some taxes. Anyone who has invested between 2 to 10 years, it attracts what we call withholding tax of about 20%. And anyone who has invested 10 years to 20 years attracts only a withholding tax of 10%. Let's take, for example, if your interest was supposed to be 1 million, when it comes through, it means government is going to take off a percentage at 20% into taxes. This is about 200,000, so your earning will be 800,000. However, if you invested long term and you were supposed to get 1 million, just like the other guy, if we put a 10% interest, this means minus 100,000, and that brings us to only 900,000. So literally, they've only taken off 100,000. So before I get to the strategy that I want you to use to manipulate all this to get the best out of bonds, let's ask ourselves, how do we start? Here is how you start. So these are our simple steps. Step number 1. If you do not have a bank account, you're going to first get a bank account with any bank of your choice. Stanbic, DFCU, Standard Chartered, Equity. Get a bank account. Step number 2, if you already have a bank account, walk to your bank and tell them that you want to open up what we call a CSD, a Central Securities Depository account. This literally means that you're opening up a bank account with Bank of Uganda, but it is your bank that is helping you to open that account. And they will give you a 2 pages form to fill. Now, this form is very simple, and the person who's going to help you will take you through. No hassle. The moment you have this account, the last step that we are going to go through is to invest. Now, this is when you decide whether you want to invest in the primary market. If you want strictly on the primary market, the bank will tell you when Bank of Uganda is going to auction again. But if there are guys who already have bonds that they want to sell, you just choose which bond do you want. Do you want a 2-year, a 3-year, a 5-year, a 10-year, a 15-year, or a 20-year? And ladies and gentlemen, you have invested in a treasury bond. So what is my winning strategy? And this is where it is beautiful. So listen to me and follow me closely. There is something called the ladder strategy of investing in bonds. The ladder strategy of investing in bonds. Most speakers and trainers tell you that you should invest your money in different months for a full year. No, today I'm going to change something. Remember, our interest for treasury bonds is biannual. It means every after 6 months we receive our money. Now I'm going to use my example. I bought a car, a Nissan Murano, a few years ago, I think in 2020. It was about 40 million. And my first piece of land was 20 million, which brings us to about 60 M. So if I had chosen not to buy this car, we are going to see how we would have invested this money in the bonds. The first strategy we are going to use is we are going to buy a bond of 20 years so that we can qualify for a 15% in interest, and we lower our taxes to 10% only. So what do we do here? Well, what we are going to do, we are going to get this 60 million and divide it by 6 months. which brings us to 10M. So this is what, my friend, you're going to do if you have 60 million. You're going to come in the month of January, it's starting a few months from now, and buy bonds of about 10 million. And then when we get to Feb, also invest 10 million in the bond. When we get to March, put 10 million. When we get to April, put 10 million. Again, when we come to May, what do we do? 10 million. When we come to June, what do we do? 10 million. So see what is going to happen. Because we've invested 10 million at an interest rate of 15%, it means we qualify for to 1.5 million in interest every year. Since it is biannual, it means after 6 months, you're going to receive, divide by 2, after 6 months, you're going to receive 750,000. Look here, look here, look here, look here. Now this is where I want you to be excited. The bond that you invested in January, by July, it's going to have made 6 months. And so they are going to pay out 750,000. Remember, we have to take off what? The 10%. What is 10% of 750? Minus 75K. Again, in August, we are going to get the biannual interest of what? Of Feb. Another 750 minus 75K in taxes. Still, in September, another 750,000 because of March. Again, October, another. In November, because of May, another 750K. In December, we also get another 750K. Of course, minus the 75 in taxes. Until you do what? You reach 20 years. Actually, I usually tell people until death. Why? Because after 20 years, you can reinvest this money. The last step you're going to do for me. Remember, how much have we been receiving? 750,000 per month. If we subtract 75,000 per month, we get 675,000 per month as our net interest. Now, if we have our net interest, what we are going to do, every month when this money comes in, we can now distribute this money to other investment ventures. Now that you've mastered about treasury bonds, let's look at treasury bills in summary. Again, if you need any special attention and help, just book our lunch hour group session. It is virtual. We help you step by step on how to start to invest. You ask personal questions, and usually there are experts in the meeting. Joy, remember to ask any question about bills should you not understand anything. How do treasury bills work? What's the difference between treasury bills and treasury bonds? Who and when should someone invest in treasury bills? And lastly, people have been asking me, how do I begin to invest in treasury bills? So today we are going to understand treasury bills because that's what you've been asking me for the last 5 days. But before we begin, I'm going to ask here again, please get a pen and a paper and note down. If you cannot, just save this video for future reference. Remember, my content is like healthy foods in a spree of fast foods. You need to be patient. It's not music, it's not dance, and it's not singing. Let's start. So how do treasury bills work? We agreed this week that we are going to be using very simple words. We shall not use coupons. We shall not use financial instruments. We shall only use words that both me and you can relate so that we can understand treasury bills to the best we could or we can. So treasury bills in simple language is the way you make an interest from loaning out money. But in this case, you're loaning it to the government. So this is how it works. The government of Uganda, just like when it comes to the bonds, government of Uganda wants to borrow money from its citizens so that it undertakes developmental projects. So it instructs the Bank of Uganda, we remember this theory, instructs the Bank of Uganda to collect money from individuals, from citizens, and then Bank of Uganda goes through the bank to get money from its clientele, which is me and you here, Puli, that has some money that they want to invest and make some interest, some benefits from it. So you loan the government money, and at a given period of time, in this case, a short period of time, this money is returned to you with an interest. As simple as that. So question number 2, what's the difference between treasury bonds and treasury bills? Because they are all similar, as you can see in the explanation. If you haven't watched my video on treasury bonds, please go in my profile. So here we have bonds, and this side we have bills. Bonds are long term. We talked about this, that they are 2, 3, 5, 10, 15 to 20 years. Yet bills are short term. Short term means that you can invest in bills. You can lend the government money for 3 months, 6 months, and 1 year. Usually they put it in days. We say 91 days, 182 days, and 364 days. So when the 91 days are done, if you have decided to invest for 91 days, your money is given back to you with something that has accrued to it, with some benefit, some interest that comes with it. That's a major difference between bills and bonds. The second, the interest rates differ. Remember we said the interest rate for bonds averages from 10 to about 15%. Yet for bills, it averages from 7 to 9%. Let us go to question number 3. When and who can invest in treasury bills? To start with, remember, we said just like the bonds, any individual, any company, any investment club, any circle can indeed invest in bills and bonds. However, who would I advise to invest in treasury bills? I only advise a person who has a short-term goal. For example, you may say that you need to put money somewhere for, let's say, buy a car at the end of the year, buy land at the end of the year, accumulate money to invest in bonds. You want to make other investments. And lastly, emergency fund. If you are putting money somewhere for a short period of time, 3, 6, 12 months, and after the 12 months you're going to need that money back, I advise you go to bills. But if it's about making money and it's a long term, it's for purposes of purely investments and making money, I would again say go to bonds or unit trusts. So anyone who has missed the video about unit trusts, still check my profile. So how do I begin to invest in treasury bills? Like the bonds, we are going to start with making sure we have a bank account. Now, I assume most of us have one. If you don't, then you'd have 2. Now, when you get a bank account, you're going to use that same commercial bank with which you have an account. Go to any branch of theirs and tell them that you want to open up a Central Securities Depository account, a CSD account. This is literally opening a bank with the Bank of Uganda, only that you go through your commercial bank. Your commercial bank means the bank you usually use. At the same time, you're going to tell the bank that you want to invest in bills. At this point, utilize the expert at the bank. Ask for details. Ask any questions before you commit. And tell them that you want to invest in bills for the period that you have decided. They'll give you a 2-page form to fill, and thereafter, literally, your job is done. You're only waiting for your money to be deducted off your account and you have invested. Simple as that. You realize I've not told you a lot of details with treasury bills because most of the information is the same as the information in the treasury bonds. And this is our final section, the bonus. We are going to understand how the NSSF Smart Life account, Flex account, is different from treasury bonds and unit trusts. And if you need any special attention and help, just book our lunch hour group session. It is virtual. We help you step by step on how to start to invest. You ask personal questions, and usually there are experts in the meeting. Enjoy. With only 5,000, every Ugandan living within or abroad can now invest and make money on a daily using the new NSSF Smart Life Flex investment scheme. By the end of this video, I'm going to tell you how it works, who can invest and what do they need, what is the interest rate and the tax rate, and finally, we shall look at how do we get to invest. Most of you have been asking me to tell you more details about the Smart Life Flex account. Now, let's go in depth. How does it work? I want you to first notice that the Smart Life Flex account works as a unit trust, that you invest in money and then you start accruing bonuses or interest on a daily basis. The only difference here, you invest as little as 5,000, it could be on a daily, on a weekly, on a monthly, or as many times as you can, and there's no limit. But whereas the interest is earned on a daily, it is actually credited on a monthly basis. So it is a compounding interest, and at the end of the month, we give you all the money. If you do not understand what a compounding interest is, please put it in the comments. If you want to know how unit trusts work, look for my video on it. The other feature of this Smart Life account that you need to know, for the first 1 year, your money or investment is locked. But after the 1 year, you can access that money as many times as you can, even when the term of investment that you chose is more than 1 year. For example, you could have said you want to invest for 10 years. But after the 1 year, you can actually access that money without any penalty. And lastly, this feature comes with digital tools. You can invest from wherever you are, online, using a phone or a web application. That's how amazing this account is. Now let's look at who can invest in the Smart Life Flex account by NSSF. Number one, it is a Ugandan living within the country and a Ugandan living without or abroad. And all you need is a national identification number, the NIN. Number two, any foreigner with a passport. And number three, any refugee with a valid identification. At this point, people would be asking, yes, I qualify, but what do I expect? What are the taxes and what is the interest? Let's first look at the interest. It is zero tax rate because this is a collective investment scheme. And like I've told you before, my friends, according to the Collective Investment Scheme Statutory Instrument number 100 of 2003, it suggests that any collective investment scheme cannot be taxed. What is the interest rate? Now, the interest rate is not standard and it's not predetermined, but we can assess or review the last 3 months from November, December, and January. November and December, they declared an interest rate of 10%, and in January, they declared almost 13% in interest rate per annum. Now, I don't want anyone to be confused here. The interest rate is per annum divided by 365 days. It determines how much you earn on a daily, and later at the end of the month, it is accredited on your account and it continues making money for you compoundingly throughout the year. This takes us to the biggest question. How do I start investing? How do I sign up? Before I get into that question, let me first give you an offer. Something that I usually give my people who follow me and they would want to know more. I have prepared a free investment guide that takes you step by step or process by process that gives you details about the Smart Life Flex account. If you're interested in it, just comment the guide. Number two, we have the daily investment challenge. If you want to join our WhatsApp community where we remind ourselves to invest on a daily, whether invest as little as 5,000, 10,000, 100,000, 1 million, and we keep on sharing experiences and testimonies, just put in comments below hashtag daily investment challenge. And the last offer is a program we've designed to help someone with personal growth and development in different monthly themes. This month we are handling personal development and growth. Next month we shall be doing personal finances. Then we shall have personal branding, how to monetize it, how to build it. Then we shall have communication skills. Then other months we shall have leadership. So if you're interested in such holistic program throughout the year to help you keep up the momentum you started with when the year was beginning, just comment mastery. This program will also allow you access to tools, templates, and guides on everything that we learn on this channel. That said, let's go to how do you start investing in the Smart Life account. You have two options to sign up. Number one, to download the NSSF Go mobile application. Second option, just browse or Google the NSSF Smart Life account and then register. Now, after going through the process of registering, how do you continue investing? There are three options, and the most efficient one is using MTN Momo. All you have to do is type in *165*29# and follow the prompts. The other options, some of them are just being rolled out, include paying using the Visa or a MasterCard. They include a direct transfer. In the guide I've told you, there's the account number. And lastly, you can use the Stanbic FlexPay. However, many people would want to know whether there's a downside of this account. There are a few things I think that NSSF can improve on. And one of the things that I think NSSF should improve, I wish they can come up with an arrangement with MTN so that MTN does not charge people when they are depositing these monies for investment. The second improvement, I think NSSF should consider crediting our money as we earn it. Since we earn it on a daily, they should give it to us so that when I'm done with the 1 year, when the money is locked, after that 1 year, I can access my money anytime, including the bonuses that I've accrued that particular day. Well, if you're here, you're done with all the sections. Now, should you have further questions, put it in the comments. I'll make more videos. But should you need urgent help, step-by-step guidance on where to start with guaranteed interaction with experts or service providers, just book our lunch hour group session. It is virtual. We help you step-by-step on how to start to invest. You ask personal questions, and usually there are experts in the meeting. The service providers help you process everything that you need. They're usually in the room. Share this video, spread the message. Don't forget, starting July 5th, we shall be hosting the Money Mambo live show, where we shall look at the 100 ways of making money every evening on Saturday and Thursday. Catch you on our YouTube and TikTok.